Visa's Q3 2026 net revenue of $11.6 billion, up 14%, year-over-year GAAP EPS of 2.97, up 10%, and non-GAAP EPS of 3.32, which is up 11%.
Right, and they immediately followed up those massive Q3 figures with their Q4 2026 guidance, projecting net revenue growth to land at the high end of low double digits.
Yeah.
And EPS growth tracking at the low end of mid-teens.
So we have the raw numbers. The mission for this deep dive is to tear into the provided source material, which is Visa's Q3 earnings report and their presentation, and unpack exactly what these figures mean for you as a retail investor.
Exactly.
We're going to analyze the underlying segment performance, scrutinize the margin pressures, and translate all that management commentary that actually built those billions.
Yeah, and to really anchor this analysis, we have to look at the baseline narrative coming straight from CEO Ryan McInerney, because the overarching theme of this entire report is his assertion that consumer and business spending remains, quote, resilient.
Resilient.
Right. Yeah, resilient. Every metric we discuss today is essentially a stress test of that specific claim. I mean, they are signaling that the foundational engine of global commerce is just humming along smoothly, totally, regardless of macro anxieties.
Well, a top-line revenue of $11.6 billion certainly suggests a humming engine.
It definitely does.
But, we need to look at the underlying volume and transaction metrics to understand how that cash was actually generated. Overall payments volume increased by 10% on a constant dollar basis.
And that constant dollar distinction it's just crucial for you to factor in.
Yeah.
Because Visa operates globally, meaning they are constantly exposed to foreign exchange volatility.
Right, the currency noise.
Exactly. When the U.S. dollar strengthens or weakens against, say, the euro, the yen, or the real, it can artificially inflate or deflate their reported revenue. So by strictly looking at constant dollars, Visa is basically stripping out that currency noise so investors can see the raw underlying behavior of the consumer.
Which is still incredibly strong.
Yeah, a 10% constant dollar increase represents genuine organic growth in just the sheer amount of capital moving through their network.
And the scale of that movement is genuinely staggering. I mean, processed transactions hit a massive 71.7 billion for the quarter.
Wow.
Which is also a 10% increase. And let's put that into perspective for a second. Processing 71.7 billion transactions in a single 3-month period breaks down to roughly 800 million transactions every single day.
That is just wild to think about.
Right. People often use the cliche that Visa is a toll booth for the economy. Like they're just letting cars through and taking a cut.
Yeah, the old toll booth analogy.
But that severely underestimates the technology involved. Processing 800 million transactions a day means they are acting as the literal fiber optic cable for global commerce.
Wow.
In the milliseconds it takes you to swipe a card, they aren't just opening a gate.
No, not at all.
They are validating your identity, checking bank balances across international borders, analyzing the data for anomalous fraud patterns, and ensuring the monetary transfer, all instantly.
Right. It is a phenomenal volume of data to process. And honestly, the most lucrative part of that data flow is found in their cross-border metrics.
The international stuff.
Exactly. So cross-border volume, excluding intra-Europe, grew by 12%. Meanwhile, total cross-border volume was up 13%.
Okay, I noticed they intentionally carved out intra-Europe from those cross-border numbers. I have to assume that's because European regulators have essentially capped interchange fees.
That's right.
So a transaction between, say, France and Germany looks a lot more like a cheap domestic swipe than a highly profitable international one.
That is the exact regulatory reality over there. Transactions occurring between two countries within the European Economic Area are just heavily regulated, which severely compresses the margins Visa can collect.
Makes sense.
So when management highlights cross-border volume excluding intra-Europe, they are pointing investors directly toward their absolute highest margin business.
Like international travel.
Yeah, travel, tourism, intercontinental e-commerce. It's an American booking a boutique hotel in Tokyo, or, someone in Brazil purchasing software from a vendor in the UK. Visa captures lucrative foreign exchange fees and much higher cross-border transaction fees on those specific movements.
And seeing double-digit growth in that specific, highly profitable segment paints a really clear macro picture. Cross-border spending is heavily discretionary.
Oh, absolutely.
If the global consumer was feeling pinched, or if the macroeconomic environment was genuinely deteriorating, that high-margin international spending would be the very first thing to contract. People delay foreign vacations when they're worried about their jobs.
Right. You don't book a trip to Tokyo if you're worried about making rent.
Exactly. Instead, 12% growth tells you that the global consumer still possesses significant purchasing power and confidence.
And that international swiping spree translates directly into their next major revenue bucket, which is service revenue. That came in at $4.9 billion for the quarter.
Which is a 14% increase year over year.
It is, yeah. But there's a mechanical quirk to how this specific revenue is booked that every investor needs to understand. Service revenue is primarily recognized based on the prior quarter's payments volume. It's a trailing indicator.
Like the ghost of the previous quarter's success.
That is precisely how it works. When banks and financial institutions issue Visa cards and generate all that payment volume in Q2, Visa assesses the service fees on that volume, but they recognize it on the balance sheet in Q3.
Right.
So that $4.9 billion is basically a reflection of the robust consumer activity from earlier in the year. And for you as an investor, this provides a built-in level of visibility.
Because we know what Q3 looked like.
Exactly. Because we know the underlying payments volume was incredibly strong this quarter at 10% growth, we already have a heavily de-risked preview of the baseline service revenue they are going to report in Q4.
So we have a clear view of the growth engine. Volume is up, transactions are pushing 800 million a day, and top-line revenue easily broke $11 billion.
Humming along.
But, and this is a big rule, but if revenue grew 14%, we have to scrutinize the cost of running this digital infrastructure. Operating expenses actually grew significantly faster than revenue.
Yeah, this is where things get interesting.
GAAP operating expenses were up 19% year over year, hitting $4.75 billion. And even looking at non-GAAP operating expenses, which gives us that smoother operational picture by stripping out one-time charges, they still jumped 17% to $3.87 billion.
That expense jump is probably the most scrutinized element of this entire report.
Well, it should be scrutinized, because I have to push back on these figures on behalf of the retail investor listening.
Okay, let's hear it.
If your operating expenses are growing at 17 to 19%, and they are noticeably outpacing your top-line revenue growth of 14%, that is usually a glaring red flag for margin compression.
Sure, in a standard business model.
I mean, in a normal business, when costs rise faster than sales, the company is getting less efficient. Why shouldn't an investor look at that 19% OPEX spike and worry that Visa is suddenly bleeding cash just to maintain its market share?
It's a fair question. But we have to evaluate what they are actually buying with that 19% increase. CEO Ryan McInerney addressed this directly by deploying a very specific term. He described Visa as the leading hyperscaler of payments globally.
Hyperscaler. That is a term borrowed directly from cloud computing giants like AWS or Microsoft Azure, not legacy credit card networks.
Exactly, and Visa's deliberately co-opting that framework because their operational reality has fundamentally changed. In the tech sector, a hyperscaler builds infrastructure that scales massively to support exponential future demand.
So they're repositioning themselves.
Yeah. Visa is telling the market that they are no longer just maintaining a legacy plastic card network. Hyperscaling means designing, building, and shipping new digital products and value-added services at an aggressive velocity. They're pushing heavily into commercial B2B payments, peer-to-peer money movement solutions, and open banking APIs.
So to maintain that 800 million transaction a day fiber optic network against agile fintech competitors, they just have to invest heavily in the unseen architecture.
Right. Think about the arms race in artificial intelligence and cybersecurity. Validating those transactions globally requires processing petabytes of data to detect fraud in milliseconds. You cannot do that on outdated servers.
No, you definitely can't.
Hyperscaling requires heavy upfront capital investment. You have to aggressively hire elite machine learning engineers, build out massive proprietary data centers, and integrate new AI models long before they start yielding direct revenue.
Got it.
So that 19% spike in OPEX is not structural inefficiency. It is management aggressively front-loading their investment cycle to secure their monopoly on the next decade of digital money movement.
Okay, spending money to build the moat. But even strategic spending can crush margins if it's left unchecked, though we can see they aren't letting this become a runaway train by looking at that Q4 guidance we mentioned at the top of the show.
Yeah, management's Q4 guidance projects operating expense growth to dramatically cool down to the low double-digit range. while revenue is expected to remain steady at the high end of low double digits.
Meaning they opened the spending spigot in Q3 to fund long-term growth, and now they're actively dialing it back to protect their profit margins.
Exactly. It proves the expense spike was a deliberate, isolated investment cycle rather than some systemic bloat.
All right, so having reconciled the record revenues and the hyperscaling expenses, we have to look at what is actually left over for the shareholder.
And the cash-generating power of this hyperscaling model is undeniable when you look at the shareholder yield. I mean, during the third quarter, Visa returned an astonishing $6.2 billion directly to shareholders.
Let's break the mechanics of that 6.2 billion down, because how management chooses to return capital often reveals their internal confidence in the stock's valuation.
Absolutely.
They deployed 4.9 billion in share repurchases, buying back approximately 14.5 million shares of Class A common stock at an average price of $330.71. Plus, they paid out 1.27 billion in standard dividends.
And plowing nearly $5 billion into buybacks in a single quarter is aggressive. Yet Visa still has $28.4 billion remaining in their authorized funds for future repurchases.
That is a massive buffer.
It is a formidable financial war chest sitting on the sidelines, waiting to be deployed to put a floor under the stock price if the market ever dips.
Right.
But within this massive capital return program, there is a highly unique maneuver buried in the balance sheet footnotes that fundamentally alters how this company generates value.
The litigation escrow deposit. This is the perfect example of why you can never just read the press release. You have to read the footnote.
You always have to read the footnotes.
On June 25th, Visa deposited $250 million into its litigation escrow account under the U.S. Retrospective Responsibility Plan.
Right.
Wait, let me make sure I'm wrapping my head around the history of this because it sounds incredibly dense.
It is a bit dense, yeah.
So before Visa was a publicly traded company, it was essentially a closed consortium owned by thousands of different banks, right?
Correct. The banks basically own the network and set the rules.
Okay, so when Visa decided to IPO and invite regular public investors in, those new public investors demanded protection. They didn't want to buy a stock only to get hit with billions in legacy lawsuits over merchant fees that occurred back when the banks were running the show.
Exactly. The public investors hold Class A shares. The legacy banks hold Class B shares. The retrospective responsibility plan was basically the legal shield built during the IPO.
Okay.
It dictates that if Visa has to pay out a settlement for these specific covered legacy lawsuits, the cost is borne entirely by the banks, the Class B shareholders, not the public Class A shareholders.
But how do they mechanically force a bank to pay for a lawsuit settlement today? I mean, let's break down the math for the listener.
Sure.
A Class B share held by a bank is designed to eventually convert into a certain number of publicly traded Class A shares. Let's say, theoretically, one B share converts into 1.5 A shares. When Visa takes $250 million of corporate cash and dumps it into this legal defense fund, they make the banks pay for it by mathematically shrinking that exchange rate.
You've got the exact mechanism. They essentially tell the banks, hey, we just spent $250 million cleaning up your old legal mess, so now your B share is only worth 1.4 A shares. They permanently adjust the conversion rate downward to reflect the cash deposited into the escrow account.
And this is where the light bulb goes on for the retail investor. When you permanently reduce the number of Class A shares those bank shares will eventually turn into, you are effectively shrinking the total theoretical share count of the entire company.
Yes. It has the exact same economic effect on earnings per share as a traditional stock buyback on the open market. You are shrinking the denominator. The total pie gets slightly smaller, which means every remaining slice, every publicly traded Class A share sitting in a retail investor's brokerage account now represents a mathematically larger percentage of the company's total earnings.
It's basically a pseudo buyback hidden inside a legal defense fund. By simply funding an escrow account to insulate the public shareholders from liability, Visa inadvertently reduces the future share count, which structurally inflates the very EPS metrics we reported at the top of the show.
It's a brilliant piece of financial architecture. A legal penalty against the legacy banks translates directly into a bottom-line boost for the modern retail investor.
That is wild.
But understanding that escrow mechanism is just as critical to understanding Visa's valuation as knowing their transaction volume. It showcases how a company operating at this scale utilizes literally every lever on its balance sheet to engineer shareholder value.
So, bringing all of these threads together, the narrative from this deep dive is remarkably cohesive. We're looking at an operation posting double-digit growth across both its top and bottom lines.
Yeah.
A resilient global consumer is driving 800 million daily transactions, which proves that cross-border travel and international e-commerce remain highly robust despite broader economic fears. And we see management aggressively playing offense. They're acting as a global hyperscaler, investing heavily in AI, fraud detection, and new payment rails to protect their technological moat, while simultaneously guiding for tighter cost controls to protect margins next quarter.
Which is exactly what you want to see.
Right. And tying the entire thesis together, they are returning capital at a staggering rate through massive open market buybacks, reliable dividends, and the unique EPS-boosting mechanics of their legacy litigation escrow account.
The financial picture is undeniably strong. But, analyzing a company at this staggering scale forces us to ask a much larger question. And it's the final thought I want to leave you with today.
Okay, let's hear it.
If you read Visa's corporate mission statement, they don't describe themselves as a credit card company. They talk about building economies that include everyone everywhere and viewing access as foundational to the future of money movement.
It's an incredibly ambitious, almost infrastructural way to frame their existence.
Right. I mean, they are processing 71.7 billion transactions in a single quarter. If you divide that by the global population, Visa is processing roughly 10 transactions per human on Earth every 3 months.
That is incredible.
So at what point does an entity of this magnitude stop being viewed by governments as just a highly successful financial services company and simply become recognized as the underlying, unavoidable utility grid of global commerce?
That's a huge shift in perspective.
Right. And if they truly are the digital equivalent of the electrical grid or the water supply, what does that mean for future regulatory scrutiny? Hyperscaling your technology brings hyper-relevance to the global economy, and hyper-relevance always attracts the aggressive attention of global regulators.
That is a massive existential question to keep in mind as we watch how governments interact with this stock moving forward. The toll booth has clearly become the entire highway system. Follow the show for daily earnings coverage.